Welcome to the deep dive. Today we're cutting straight to the chase. XPENG's latest Q2 2025 results and what's next.
Yeah, it looks like a potentially pivotal moment for them.
Exactly. We want to give you those crucial insights fast. Let's unpack these numbers.
Okay.
So these are the unaudited Q2 results, just out August 19th. XPENG CEO, Mr. Xiaopeng He, is talking about a transformation.
He is. And the source material really leans into that narrative. Record high performance across the board, deliveries, revenue, margins, cash.
Record highs. That sounds promising.
It does. The analysis suggests they're showing, a credible path away from just spending heavily on R&D and racking up losses towards actual sustained profit.
That's the dream for a lot of EV makers, isn't it? A credible path.
Absolutely. Especially in this market. It's fiercely competitive.
Okay, so for you listening, the big question is,
Mm-hmm.
how do they pull this off? What do these numbers really show? Let's dig into the financials.
Right. Let's get to the proofs.
Starting with the top line, total revenues, RMB 18.27 billion. That's about, what, $2.5 billion US dollars?
Roughly, yeah.
Yeah.
US $2.55 billion.
And the key thing here, they more than doubled revenues compared to last year, up 125% year over year.
Huge jump. And still growing nicely quarter over quarter, too, up almost 16% from Q1.
In vehicle sales specifically, that revenue was RMB 16.88 billion.
US $2.36 billion there. And that's up nearly 150% year over year, mostly as you'd expect from delivering way more cars.
Which brings us to those delivery numbers.
Exactly. That's the engine here. They delivered 103,181 vehicles in Q2.
Over 100,000. How does that compare?
It's massive. It's a 241.6% increase from the same time last year. They only did about 30,000 back then.
Wow, 241%. So they're really scaling up production successfully then, not just taking orders.
It certainly looks that way. Meeting that demand, getting cars out the door, that's a big hurdle cleared for a growing EV company.
Okay, top line is strong, but profitability, that's often the tricky part in the EV world. How do they do there?
This is where it gets really interesting. As the source material highlights, gross margin hit 17.3% for the quarter.
17.3, is that good?
It's very good for them. A new historical high, actually. That's up 3.3 points from last year and almost 2 points from last quarter.
Okay, impressive. And the margin just on the vehicles themselves.
That improved significantly, too. 14.3% vehicle margin.
And how much of an increase is that?
Almost 8 percentage points better than Q2 last year and nearly 4 points better than Q1 this year.
8 points year over year. That's substantial.
It is. And their co-president, Dr. Goom, made a point of saying vehicle margin has now improved for 8 straight quarters.
8 quarters in a row. That's real consistency. How are they managing that?
Well, according to the analysis, it's a few things. Ongoing cost cutting, for one, getting more efficient,
Makes sense.
and improving the product mix, selling more higher margin models, plus better pricing power, and critically, a growing contribution from software and services.
Ah, the software side. That's often touted as a higher margin play.
Exactly. It suggests they're not just building cars better, but people are buying into the whole tech package, the ecosystem.
Okay, so margins up significantly. What about the bottom line? Still losing money.
Yes, still a net loss reported, but it shrunk dramatically.
How much smaller?
The official net loss was RMB 0.48 billion. That's about 70 million US dollars, which sounds like a lot, but it's nearly 63% less than the loss in Q2 last year.
Okay, so moving in the right direction.
Uh-oh.
Significantly.
Definitely. And the non-GAAP number, which smooths out some items, shows an even bigger reduction, down 68% year over year, closer to RMB 0.39 billion.
So they're bleeding less cash on operations, but how's their overall cash pile? Are they funding this progress okay?
That seems to be a strong point. Their cash position is quite robust. They ended Q2 with RMB 47.57 billion,
Which is?
about US $6.64 billion, and that's actually up 5% from the end of Q1.
So they have a good buffer.
Exactly. The source calls it a liquidity buffer. It gives them room to keep investing in R&D and growth without, running to the markets for cash immediately.
Speaking of investing, what about their expenses? R&D and sales.
Both up, which you'd expect with growth and innovation. R&D spending jumped over 50% year over year to RMB 2.21 billion.
Why so much?
Primarily new models and technologies. They're not slowing down on innovation.
Right. And selling expenses.
Selling, general, and admin SG&A, that was up about 38% year over year to RMB 2.17 billion. Mostly higher sales commissions because they sold more cars, plus marketing. Standard stuff for growth.
Okay, so the financials paint a picture of strong growth, rapidly improving margins, and a narrowing loss. all backed by a solid cash position. Impressive turnaround, it seems.
The numbers certainly tell that story.
But what's driving this? Beyond just building cars efficiently, what are the strategic pillars here?
Right. The source material emphasizes that their heavy R&D spend isn't just cost, it's an investment in a, quote, durable competitive advantage. There are three main pillars highlighted.
Okay, what's first?
First, AI-driven autonomous driving. Their XPLOT system apparently has 85% penetration among urban users now. That's a ton of real-world data.
That data feeds the learning loop.
Exactly. And crucially, they're developing their own AI chip, the Turing chip.
In-house chip. Why is that important?
Control, speed, less reliance on others like NVIDIA maybe. It lets them tailor the hardware to their software and iterate faster.
Makes sense. Pillar 2.
Battery innovation. Their XPENG system uses an 800-volt architecture, which allows for faster charging. And they're talking about extended range solutions up to 1,400 kilometers.
1,400 kilometers. Seriously.
That's the claim for the extended range solution. It directly tackles range anxiety, huge barrier for many potential EV buyers. That kind of number if real world is game-changing.
No kidding. Okay, AI driving, battery tech. What's the third pillar?
Global partnerships. And this one is big. They announced a major deal with Volkswagen just before the earnings on August 15th.
Right, I saw headlines about that. What's the deal exactly?
They're expanding technical collaboration on e-architecture, essentially the car's electronic nervous system. VW is licensing XPENG's software-defined architecture.
VW licensing tech from XPENG.
Yes. That's huge validation. It's expected to cut XPENG's own R&D costs related to this by 40%.
Wow.
And it opens up a whole new revenue stream selling their technology, not just cars. It really validates their tech on a global stage.
That VW partnership feels like a potential game changer. But does partnering so closely with a giant like VW create risks? Dependency, maybe? Giving away the secret sauce?
That's a fair point to raise. The source focuses on the upside, cost savings, validation, new revenue. XPENG's leadership seems to frame it as accelerating their software plans and solidifying their tech leadership.
So they see the benefits outweighing the potential strategic entanglement.
It seems so. A calculated risk, perhaps, to gain significant advantages in cost and market perception right now positions them more as a tech provider.
Interesting angle. Okay, beyond the tech strategy, what about the physical side? Stores, chargers?
Also expanding rapidly. As of the end of June, they had 677 stores across 224 cities.
That's quite a network.
And the charging infrastructure is growing too. Over 2,300 self-operated stations, and more than half of those, 304, are their super-fast S4 and S5 chargers.
Tackling charging availability head-on. That's crucial for buyers.
Absolutely. So you combine the R&D focus, the partnerships, the infrastructure build-out. It fits this vision of being a smart mobility solutions provider.
Creating a flywheel effect, the source called it.
Exactly. R&D investment leads to better products and tech, like the software VW wants, that drives sales and maybe licensing revenue, which funds more R&D, faster iterations, better margins. The whole cycle speeds up.
And new products are hitting the road from this.
Yep. The G7 family SUV launched and started deliveries right after the quarter ended in early July. And deliveries for July overall were strong, almost 37,000 vehicles.
Keeping the momentum going. Okay, so based on all this, what's the outlook? What are they telling investors to expect for Q3?
They're guiding for continued strong growth. Vehicle deliveries expected between 113,000 and 118,000.
So potentially even higher than Q2.
Potentially, yes. That range represents a year-over-year increase of roughly 143 to 154%. Massive growth continues.
Fan revenue.
Projected between RMB 19.6 billion and 21.0 billion. Again, a huge year-over-year jump, about 94 to 108%.
Those are bullish forecasts.
They are. And the source analysis suggests this puts them nearing a break-even inflection point.
Nearing break-even. That's the milestone everyone watches.
Sure.
But there are always risks, right?
Of course. Execution is key. Can they deliver on the promise of the Turing chip and their autonomous platform, the XNGP? Keep it ahead of competitors?
Competition isn't letting up, I assume.
Definitely not. Tesla, BYD, all the others, it's intense. That could always pressure margins. And expanding globally brings its own headaches, regulations, supply chains.
So how do they mitigate those risks?
Well, the improving margins we talked about show they can manage costs. Having diversified revenue streams, like potentially from software licensing via the VW deal, helps. And these strategic partnerships spread the risk and cost.
So for you listening, what's the big picture takeaway on the timeline?
The source suggests actual profitability might still be, maybe a year or two away. But the narrative has shifted.
How so?
XPENG isn't just seen as a company burning cash to grow anymore. It's viewed now as a tech-focused EV player with a much clearer path towards making money. That's a fundamental change.
A shift from growth at all costs to growth with a path to profit.
Exactly. More disciplined, more focused on sustainable financials, leveraging that tech investment.
So summing up, we've seen XPENG demonstrate a significant transformation this quarter. Strong deliveries, revenue growth, impressive margin improvements, and strategic moves in AI, batteries, and that key VW partnership.
Yeah, it's a compelling story of moving towards a more sustainable model.
Which leaves us with a final thought, perhaps.
Well, it does raise an important question for the future, doesn't it? In this incredibly crowded EV market, can this focus on deep R&D and these big partnerships truly create a sustainable advantage for XPENG?
Can they build a moat that lets them reach consistent profitability and maybe even set a new standard?
That's the billion-dollar question, really. Or maybe the multi-billion-dollar question now.
Something for you to definitely chew on as you watch this space evolve. Thanks for joining us on the Deep Dive.
Thanks, everyone.